Hi everyone. So today I'm with Dom, and today we're going to be doing another investor profile for Stanley Druckenmiller. He's one of the world's most famous investors. Dom is going to cover his background, and then I will cover his performance, his investment philosophy, and what he's currently invested in. Dom, whenever you're ready, please take it away.
Thank you. Let me know when you can see my screen.
Yeah, perfect.
Awesome. So just going to go over Stanley, a little bit about his early life, kind of his contributions to the stock world, and then kind of where he's at today.
Great.
So we'll just jump right into it. So just really quick on his background. He was born in 1953 in Pittsburgh. Didn't really come up from money. Ended up going to college and he studied English and economics at Bowdoin College, and then eventually became had a financial career at Pittsburgh National Bank as an oil analyst. And then in 1981 is when he founded it. I'm going to butcher this. Duskany Capital Management. I don't know if that's said correctly. Hopefully I did. If not,
Duskin
some
Duskin?
Duskany.
Yeah,
I'll
I don't
take that.
know. It's something.
If
Yeah.
not, someone in the comments correct us because sometimes we can't always get the words right. But anyway, he founded this capital management company, and it was known for becoming bold, data-driven trading. And then eventually, he ended up moving from the company, and he joined George Soros's Quantum Fund and became the lead portfolio manager in 1988. And this is important because, as we see in Chapter 2, he helped make some history in terms of trading. So it says in 1992, while working under Soros, he proposed shorting the British pound, predicting it couldn't stay in the ERM, which is the exchange rate mechanism. And then Soros ended up approving, and they went all in. And this actually was really good for them, as we can see. It says when the UK exited the ERM on Black Wednesday, is what it ended up being called. The Quantum Fund made over $1 billion in profit. Huge, huge. So that call was huge, and they made a metric ton of money. And this is kind of one of these more or less known for is doing this. And we'll see kind of a little bit later that part of his investment strategy involves kind of like a lot of high risk but really high reward type investments like this, because obviously putting all your eggs in one basket isn't always the best financial advice. But if you do it right, you can be like him, make over $1 billion. So sometimes it pays out. So the article also states that he was behind the brains of the trade, like I mentioned, and then Soros gets the headlines. Everybody kind of wins on that one, and that kind of cemented him in like the investor world per se, for having a sharp mind in macro investing, from seeing it from that point of view. But it wasn't all good for him. He did have some investments that didn't go over as well. This is kind of common with a lot of people, especially in the earlier days. So as we can see here, the dot-com bubble was his setback. So it says here in early 2000, during the peak of the dot-com bubble, he bought tech stocks just before the crash. Not too surprising. Everybody was in the tech stocks in the early
Yep.
2000s. Dot-com bubble crashes, loses a ton of money, all that great stuff. Basically, a lot of companies went bankrupt because of it and that kind of stuff. Tons of capital lost. It was really a bad time for investors everywhere who were banking on those tech stocks to really jump up. And so, what are some of the lessons from it? So, first, he admitted to abandoning his process and following the crowd, which was his biggest mistake, because he wasn't doing what he did before, like when he did with the British pound. He was getting a little too emotional, saw the wave and wanted to get on it. And then it says losses were significant, and he described the emotional toll as devastating. And then shortly after, he actually stepped down from managing the Quantum Fund because of that investment. So after he left there, he returned to his previous fund. Again, can't don't I don't want to butcher it, so let's call it his previous capital management fund, and delivered constantly strong returns with almost no losing years. So a nice little rally. And it says in 2010 he made a surprising move. He voluntarily closed the fund, citing emotional toll of managing client money, and then. He says that the firm actually had returned over 30% annually for 30 plus years. Pretty good. Not too bad, if I have to say so. And then eventually transitioned to managing his own wealth through a family office, and that's kind of more or less where he's at now. There wasn't too much else we could really find on the family office per se. So I guess just kind of just does it privately, no longer in a public sphere. And so now the article gives a little bit more about his influence on today and investing strategy. Basically, he's a big picture macro bets. It was what he was known for. His flexibility with risk and risk management, and then combining fundamental conviction with technical timing. It says he's bullish on AI, semiconductors, and U.S. innovation, while often cautious about U.S. debt and inflation. Pretty solid tips there. So here's his main takeaways overall from the journeys he went through. First is number one, size your bets when conviction is high. He wasn't afraid to go big like shorting the pound in 1992. Don't follow the herd, as we saw in the dot-com bubble. He followed it, got a little emotional, ended up biting him in the butt. So it says mistake in 2000 caught him, but the emotional discipline and know when to walk away. Closing the original capital fund he started wasn't a failure. It says it was a strategic decision, as he cited the emotional toll, probably just easier on his mental health and all that, just not have to run the whole thing. Then finally, simplicity beats complexity. He says, I focus on big bets and don't diversify much. So, like I said before, sometimes putting your eggs in one basket can pay off if you have
Yep.
the right basket, but it can be a tough one. You kind of have to really know what you're doing, like he did, to make such a good move. But high risk, high reward, that's how it goes. So, that's a little bit about him and his background, where he's at today, some of the lessons he did, and his contribution to the investing world. So, we'll let Matt take over and kind of go over more about the performance.
Okay, great. Thank you, Dom. Great
Thank you.
background. Yeah. All right. So Dom touched upon about it a little bit when he was reading the article. And like I said, I'm going to be doing the performance first. And of course, his performance is spectacular. Like Dom said before, 30% average annual return for 30 years. This includes Soros as well. When he was pretty much running the fund, he wasn't really a co-investor, but he was running the fund with Soros. Then you have, just as an example too, because at least ChatGPT likes to do this, it was in 1,000x return. So $10,000 would have been $26 million. Wow. So very good, very good. Saying it beat, that's far beyond Warren Buffett and Peter Lynch. So he does have one of the best records in the trade. He was a lead portfolio manager for Quantum Fund. That was Soros' fund. He played a key role in the British pound, like Dom said, or breaking the Bank of England. Known for aggressive macro bets, huge position sizing, and cutting losses. He returned after 2010. He returned to outside capital. Now he runs his own family office. So he had 0 down years over decades. He's possibly the greatest macro trader alive. So yeah, he's really more known for it as a trader than an investor, but still he does make some long-term investments nonetheless. Keep in mind, and he does have really great discipline and patience when it comes to that. So some of his transitioning over, so that was his performance. Now his investment philosophy, which I think is just his investment philosophy is just as important as anything else, is he has 3 things: conviction, macro awareness, and risk control. So number 1 is bet big when you know you're right. Don't diversify for the sake of it. When you have high conviction, go big. Small bets don't move the needle. 100% correct. Cut losses aggressively. He hates being wrong for long. Will exit quickly if the thesis breaks. He doesn't care what. And more specifically, in interviews, he said he doesn't care what he pays for it. He will cut losses if the thesis just loses its traction for him, and he doesn't like that trade anymore. This is why he has had no down years for decades. Top-down macro first, unlike pure stock pickers, starts with interest rates, inflation, central bank policy, economic cycles, then finds assets, stocks, currencies, bonds that benefit. Example, his role in Black Monday against the British pound. Ride trends, don't fight them. Loves the momentum plus fundamentals together. Will stay in a long winning trade as long as the trend is intact. Don't sell just because something looks expensive. Very different from value investors. He looks for huge upside, limited downside, of course, like every investor. Be flexible, not a value investor, growth investor. Will switch views quickly if data changes. No ego in being wrong. Concentration over diversification. Often runs very concentrated portfolios, like Dom would said. Combine fundamentals plus liquidity, earnings and business quality, but also liquidity, capital flows, market sentiment. This is what separates him from traditional investors. And so pretty much it says more or less the same thing. And the current portfolio that he's rolling with right now in early 2026, well, this is Q4 2025, so we have it for reported in February 2026, the most recent, at least for us, public information. So we have Natera, which is I believe it's a genetic company or a DNA genetic company. 13% of his portfolio, that's the number 1 pretty much. Amazon, of course, Google, Teva, which is pharmaceutical. I believe Dom and I actually cover that in Insmed, and that's biotech exposure. A couple of the other macro trade bets, very Druckenmiller. These are super important. This is where macro view shows up. Top four holding was RSP, XL. I mean, they're like 6 or 7%, but I'd be concentrated on these individual names. He's just gonna have macro bets on like countries. Like I know he's more bullish on Brazil as a long-term bet because it's considered an emerging market, a growing emerging market, excuse me, that seems more financially stable nowadays. Then he has a couple cyclicals like Delta United, which is good economic growth, and then he has like smaller positions like in Copang, which Dom and I covered. C Limited, we covered that as well. Lattice Semiconductor, which is one of the smaller semis. Alcoa and Integris, I think that's an energy company. So yeah, what he sold, he reduced Meta, Nvidia, ARM, which is a semiconductor company, and other AI heavy names. So he thinks AI trade got crowded expensive. True, I agree with that actually. And what the portfolio is saying, rotation out of Mag 7, selling some AI winners, buying equal weight S&P, RSP, ETF, bullish on financials economy, global commodities exposure, Brazil, bet, weak dollar, strong commodity cycle. So I think he's right. It's important context though, and I think this should be at least noted. Portfolio size is about 4.4 to 4.5 billion. 60 holdings altogether. Top 10 holdings are in 50 plus percent of their portfolio. So, and keep in mind, it doesn't show options, commodities, or shorts either. But still, altogether, you could say this is his quote: AI was a trade. Now I'm rotating to cyclicals, international markets, and underground sectors like biotech. So that's where his head is at currently for 2025, late 2025, early 2026. And I think he's pretty much on point. Dom, is there anything else you wanted to add?
No, I think you did a pretty good job hitting it all.
Okay, great. All right. Thank you, Dom. And thank you, everyone.
Thank you.